now solve question number 14 from our test your knowledge of ICAI study material. This is a newly introduced question. Previously question number 13 was the last one. We have a similar question in our study material also, question number 27 in our class material. However, this is same thing with slightly different numbers. They want you to compute goodwill under super profit method, and there is a unique adjustment when it comes to unrealized profit. Can we begin? Start reading this question. The following information from the balance sheet of X Limited as at 31st March 2021 is being made available. Don't waste your time reading this balance sheet extract. Quickly come to the end of the question and see what is it that they need. They want you to prepare ledger accounts to close the accounts of X Limited. Okay. And they also want you to prepare balance sheet. They haven't asked you to pass journal entries in the books of transferor. They haven't asked you to pass journal entries in the books of transferee. In the books of transferor, they need ledger accounts. In the books of transferee, they straight away need balance sheet. In this question, balance sheet is going to be very easy. You know why? Because they haven't given the transferee Y Limited's balance sheet. So whatever is your PC, NATO, asset variation, revaluation, computation is there. Same will appear as balance sheet. If Y Limited's balance sheet was given, we were supposed to take the numbers from Y Limited's balance sheet, add the impact of this amalgamation to it, and then prepare the balance sheet of Y. So because Y Limited's balance sheet is not given, this is going to be a very cute, sweet problem. Can we begin? Let's start. To start with the same process, let's read this adjustment. Y Limited agreed to absorb X. Can I say Y Limited becomes our transferee and X Limited becomes our transferor. After this, what is it that we have? PC method and nature of amalgamation. We'll figure that out eventually. Now start reading. Y Limited would take over all the assets except bank and patent. Okay, so they are not taking over bank, they are not taking over patent. Be cautious with this. Charge issue. So we aren't taking over bank, we aren't taking over patent. Other than this, all other assets are taken over. Then what value are we taking them over? Taking them over at book value less 10%. So we are taking over building, machinery, inventory, trade receivables at book value less 10%. Bank and patent are not taken over. Share issue expense is anyways not an asset. Little tricky, yeah? They should have used commas little wisely. They haven't, but you be aware that Y Limited would take over all assets except bank and patent. Comma, should have given a comma here. At their book value, meaning it is not patent is taken over at book value less 10%. All assets except bank and patent is taken over at book value less 10%. Patent is not taken over only. I'll tell you why is it still correct without that comma. You cannot say, no, I'll take over bank balance at 10% less book value. Your bank balance is 1 lakh, give it to me, I'll give you 90,000. Who accepts to that? So basic understanding here is bank and patent is not taken over. Other assets are taken over at book value less 10%. And goodwill is to be valued at 4 years purchase of super profits. Goodwill is to be taken at 4 years purchase of super profit. So we should take super profit multiply by 4 years purchase. When we take super profit multiply by 4 years purchase, we will get goodwill. So how do we get super profit? It is average profit minus normal profit. How much extra profit have we earned over others? Average profit is being made available to us slightly later, I guess. Super profit, assuming that normal rate of return is 8%. On the capital employed, I should apply 8%. Once I apply 8% on capital employed, I'll get normal profit. I'll take average profit or adjusted average profit, deduct this normal profit, I'll get super profit. Multiply by 4 years, you will get your goodwill. And combined amount of share capital and general reserve. Okay, they're basically telling us that general reserve plus share capital together will become our capital employed. Let's begin. This first part anyways will take it in PC computation, NATO. I'll take that and this together. Shall I start doing it? Come on, let's start with our purchase consideration computation. How do we compute our purchase consideration? Let's take all the assets at agreed value, that is book value less 10%. I'll start from building because before building whatever is there is liabilities. Building 1,70,000, I'll take it over at less than 10% less of 1,70,000, 1,53,000. Next I have with me machinery. Machinery I will take it over at 3,20,000 minus 10%, that comes to 2,88,000. Then I have inventory. Inventory 1,10,000 minus 10%, that comes to 99,000. Then I have trade receivables, 1 lakh 30 minus 10%, that is 13,000, 1 lakh 17. Stop there. Bank and patent are not taken over. So we will not write it. So you told take all assets. That's in realization. This is PC computation. In PC, we'll take NATO into consideration. In NATO, we take only assets taken over. That too at agreed value. I hope you understood this. Then let's see liabilities. Is there any liabilities taken over? No liabilities taken. They've taken, okay, trade payables is taken over. Why limited to take over trade payables at book value? So we actually have a lot of liabilities. Trade payables, loan, debentures. Loan and debentures are not taken over. Loan and debentures are not taken over. Only trade payables is taken over. That too at book value. Less liabilities, which is trade payable. How much is trade payables? 1 lakh 60. All right, minus 1 lakh 60. Help me with net assets taken over. 153 plus 288 plus 99 plus 117 minus 160. 4 lakh 97. To this, I should add goodwill to arrive at purchase consideration. Goodwill, they haven't given the amount, unlike few other questions. They want us to compute the amount of goodwill, which we will do now. Shall we compute goodwill? Goodwill is to be computed under super profit method. So I would have to take normal profit and average profit comparison. If average profit is more than normal profit, I will get super profit. That is average profit minus normal profit. I should multiply it by 4 years purchase. How many years purchase given in the question? 4 years purchase. When I multiply it by 4 years purchase, I would get goodwill. Did everyone understand? How do we get normal profit? Normal profit is found as capital employed multiplied by normal rate of return. And in the question, they have told capital employed is share capital plus general reserve. They only told here. See, combined amount of share capital and general. Come to the question. How much is share capital? 4 lakh. How much is general reserve? 40. I would write share capital 4 lakh, general reserve 40, 4 lakh 40. Normal rate of return is 8%. Apply 4 lakh 40,000 into 8%. 35,200 becomes your normal profit. Average profit is not yet given. In the extent I've read, it's not given. It will be given later. Third adjustment, no. Here they mentioned. Average profit is how much? 62,200. Let's not go there. Before I go there, I've done with first adjustment completely. I'm done with second adjustment completely. Third adjustment they mentioned, PC is to be paid in cash to the extent of 3 lakh. The moment they're paying PC in cash, can I say this becomes amalgamation in the nature of purchase? Another point is assets are taken over at agreed value. That is also another point. And PC is payment method. Sorry, net asset taken over with some payment details being made available. And they've told how much cash will be given? 3 lakh. See, right now I cannot close my NATO. Sorry, I've closed my NATO. I cannot close my PC computation because to NATO of 4 lakh 97, I have to add goodwill, only then I'll get PC. Once I find this PC, I'm going to distribute it in cash to the extent of 3 lakh. And balance, if they give, no, I can actually find total PC using that I can find goodwill. But they have not given the balance. Check this out. And the balance in fully paid up equity shares of rupees 100 each at 125. So I have to give equity shares in Y Limited. How much? I don't know. How will I get to know? I will close my second working note by filling average profit, by finding goodwill. Once I find goodwill, I will add goodwill to NATO. Then I will get total PC. From total PC, if I deduct 3 lakh, then I'll get number of equity shares to be issued by Y Limited in PC. Remember, issue price is 125. I hope everybody understood. Very nice. Come on. Next, basically, I'm trying to do the question in the order of the data given so that nothing will be missed. Have we finished 1, 2, 3 adjustments? Read this. Average profit is 62,200. Take here in our goodwill computation, average profit 62,200. Capital employed 4 lakh 40. Normal rate of return 8%. 4 lakh 40 into 8%, 35,200. This will become our normal profit. On an average, we want profit of 62,200. We have earned more than others. How much more have we earned over others? 62,200 minus 35,200. 27,000. I am a superman. I earn what 27,000 more than others. How many years can I continue to earn this extra profit? 4 years. So if I multiply this average profit per year, super profit per year, which is 27,000 with 4, I'll get goodwill. So in this case, how are we finding goodwill? Number of years purchase. I hope everybody understood this. 1,08,000 becomes goodwill. Come back to working note number 1. NATO 4,97,000. I would add goodwill of 1,08,000. 497 plus 1,08,000. 6,05,000 will become our purchase consideration. 6,05,000 is settled by 3,00,000 rupees cash. Balance to be given by equity shares is 3,05,000. This is not 3,05,000 shares. It is 3,05,000 rupees. Nominal value of the shares is 100. What is the nominal value of the shares? But issue price is 125. Number of shares to be given is 3,05,000 divided by 125. 2,440. So can I say we are going to issue 2,440 shares of rupees 100 each at rupees 125. By this I am done with my PC computation after NATO and goodwill. What's next? Let's start doing accounting in the books of transferrer, ledger closing. We still have some information. Liquidation expense amounting to 8,000. Who has paid it? They haven't told anything. I will assume it is paid by transferrer, because if transferee had paid, they would have mentioned transferee. We are assuming that transferrer has paid 8,000 liquidation expense, not reimbursed by transferee. Y Limited sold 31st March unrealized profit adjustment. We'll treat this once again when we do adjustment for transferee books, not now. And they're told 50,000 worth of goods is still remaining. That's it, yeah, unrealized profit. And trade payables include 20,000. Mutual indebtedness. There is no D adjustment. I told you, DRUMS adjustments. D debenture adjustment not there. R realization expense in transferee books not there. Unrealized profit and mutual indebtedness. UM. We have 2 adjustments. Statutory reserve is not there. We have 2 adjustments to do in the books of transferee. In whose books? When will we do it? Later. For now, no. Wait. Can we begin our ledger accounts? Yeah. Think of journal, pass the ledger. Think of journal, pass the ledger posting. What is the first thing that we should do? Transfer all the assets, whether taken over or not, to realization account at book value. Transfer all the liabilities also to realization account, whether taken over or not, at book value. Exception being 2 things: equity share capital and reserves and surplus. Don't transfer. Bank account, don't transfer if not taken over. And when I say reserves, it will also include unamortized expenditure. Can we begin? Let's start with the first one. Shall I start with assets? Building, machinery, inventory, trade receivables. Ashte. I will not transfer bank and patent. Sorry, I'll transfer patent. I'll not transfer bank. Shall I do that? Realization account debit. 2. Building. What is the value? 1,70,000. 2. Machinery. 3,20,000. 2. Inventory. 1,10,000. Sorry, it's taken over 10% less. Realization account. Transfer everything at book value. After inventory, 1,10,000. Trade receivables, 1,30,000. Bank balance not taken. Open one bank account. On the debit side, you write balance brought down 60. This is useful. We'll receive 3 lakh cash from them. We will pay realization expense. We will pay to debenture holders and loan because it's not taken over, and balance will be paid to equity shareholders. They'll be balancing here, a balancing figure in this ledger. That will be equity shareholder account. What's after that? Bank, patent. It is not taken over, but still transfer. We will later sell this at 0 rupees. We will later sell this at, why? They have not given any money. I told you, if they don't mention any price, asset is assumed to be sold at 0, liability is assumed to be settled at book value. What is it after patents? Share issue expense. This is to be later transferred to our shareholder account. Did everyone understand? I've transferred all the assets. Then come to liabilities. What do we have? Trade payable, loan and debenture. I'll write by trade payable, by loan, by debenture. What values? 2,80,000 and 1,60,000. Understood? Trade payable, loan and debenture. Liabilities are also transferred at book value to realization. Then I'll pack this box and then give it to my transferee. Entry: transferee company account debit to realization. In realization, I'll write by transfer. What is the name? Y limited. This is for PC due. PC amount we've just computed. How much? 6 lakh. PC 6 lakh 5. Here at 6 lakh 5. In realization, I wrote by Y limited 6 lakh 5. I'll open Y limited account. Oh, I haven't opened one. Let's open Y limited ledger. What would I write here on the debit side? 2. To realization. How much here? To realization? 6 lakh 5. Then you should write receipt of PC. Am I right? Receipt of PC, cash account or bank account debit, equity shares in Y limited account debit to Y limited. So here I'll write by bank account. How much cash? Very good. By equity shares in Y limited. Ignore that premium 25 and everything. Just write the amount. 3 lakh 5. That security premium separation should be shown in the books of Y limited, not in X limited. I hope everybody understood. Y limited is transferee. After this, PC is also received. Now, assets not taken over to be sold. There is one asset not taken over. Patent. I am assuming that it is sold for 0 rupees. There is one liability. No, not one. 2 liabilities not taken over. What are they? Debentures and loans. What do? I'll pay them. What is the entry when you pay? Realization account debit to bank. So in realization account, I would write debit side to bank. You want me to write 2 times or 1 entry is good? 1 entry. How much? 2 lakh plus 80. 2 lakh 80. If you want, I can write them 2 times. 2 lakh separate entry, 80,000 separate. In realization, I wrote 2 bank. In bank account, I'll write by realization, debentures and loan paid off 2 lakh 80. Assets not taken over, settlement done. Liabilities not taken over, settlement done. What next? Realization expense. There is realization expense paid 8,000. Entry realization account debit to bank 8. In bank account by realization account expense paid 8. Then we should first pay our preference shareholders. In this question, there are no preference shareholders. We should then pay our equity shareholders. First identify realization profit or loss. Close this ledger by taking balancing figure. 6 lakh 5, 7 lakh 65, 8 lakh 65, 8 lakh. I think there is loss. 10 lakh 3, sorry, 10 lakh 83. Deducted. How much do we get? Realization loss 38,000. In realization account, I'm writing by equity shareholder. In equity shareholder account, I would write to realization account 38. Done. Realization ledger closed. Now we will identify the amount payable to equity shareholders. How do we do it? Very simple. Close your share capital, reserves and surplus, accumulated losses to shareholder. First write share capital account debit, reserves and surplus account debit to shareholder. How much is the share capital? 4 lakh. I'll write by share capital 4 lakh. We are supposed to pay them that debentures BD, loan BD, trade payables BD, general reserve by general reserve 40. Then building machinery, inventory, trade receivable, bank patent, share issue expenses is accumulated losses not written. This has debit balance. This has to be credited. Entry will be shareholder account debit to share issue expenses 17. Did everyone get it? Now we have to pay money to our shareholders and shares. We have some cash, not 3 lakh. We have some cash. Come to bank account. We had 2 lakh, we had 68,000 with us. We received PC. I forgot to write here. We received no 3 lakh rupees from Y limited. In Y limited, I wrote here by bank. In bank, I should have written. Sorry, I forgot. Out of 68,000 that I had in the beginning plus 3 lakh what I've got, I've paid 2 lakh 80,000 to my debenture and loan and 8,000 towards realization expenses. So how much is remaining now? 80,000 will be paid to our equity shareholders. In bank account, I'm writing by equity shareholders. In equity shareholders account, I'll write by bank. How much? Sorry, to bank. To bank. Sorry, payment 80,000 done. balance will be settled by way of equity shares in Y Limited. 4,40,000. In that 4,40,000, 17,000 share issue expense they won't get. Loss of 38,000, deduct 17 and 38. And also deduct 80,000 what we already paid them by bank. You will get the balance is equity shares. That should be equal to 3,05,000 because that's the exact extent to which you got shares. You get 3,05,000. Ta-da! This is the closing of books of accounts in the books of Transferror. Now, in the books of Transferee Company, which is Y Limited, they've asked balance sheet after amalgamation. And trust me, guys, this is only extract. Sir, why? If Y Limited is an existing company, Y Limited should have some share capital, some reserves, some assets. They've not given it. So we'll only write X Limited's assets, liabilities taken, and shares given to X Limited. Are you guys clear with this? Say something. I'm not writing journal entry, business purchase to liquidator, asset to liability to business purchase, liquidator to share capital to cash to security premium, and then DRUM. I'm not writing entries. Straight away I'll prepare balance sheet because they've asked only balance sheet. See this PC computation. This is going to help us a lot. Keep this in hand. Take each asset at the values that they've given and keep DRUMS in mind. Is there debenture adjustment? No. Is there realization expense adjustment? No. Is there unrealized profit? Yes. Is there mutual indebtedness? Yes. So basically inventory and trade receivables will have adjustment. Inventory, unrealized profit adjustment is there. This one, mutual indebtedness adjustment is there. And mutual indebtedness is not just for trade receivable. It is there in trade payables. But actually trade receivables of one company, trade payable of the other. But we don't have that information. So when we write this, we need to deduct. I hope you understood. Can we begin? I'll give you an heads up how the balance sheet will be. These four items will become balance sheet asset. This will become balance sheet liability. Inventory and debtors will eliminate little and trade payable also will eliminate little. Then this PC given, this cash will appear as a negative cash balance. Bank overdraft only. Why? You can't have negative cash balance. No. This will appear as BOD in balance sheet liability side. This is our share capital but not completely. Why? 2,440 shares into 100 will be share capital. 2,440 shares into premium of 25 will become security premium. And goodwill will also come. Whatever you have computed, 1 lakh. That anyways we have it here. This is how your balance sheet will look. Shall we begin? Okay, let's write building and machinery. Where do we write building and machinery? In my property, plant and equipment. Shall I? Tangible assets 153 and 288. Let me take you to notes to accounts. Property, plant and equipment. I would write 153 building, 288 machinery. I hope everybody understood. Come to the next adjustment. I would write my inventory 99, but I have to adjust it for unrealized profit. Shall I? Okay, come on. Let's see that unrealized profit adjustment now. We'll do that working. Observe, yeah. What is that adjustment of unrealized profit? It starts here. Y Limited, prior to 31st March. Remember, Y Limited is transferee. Till now, the adjustments were transferor had sold. In this question, who has sold? Transferee has sold. How much? Goods costing rupees 60,000 to Y X Limited for rupees 80. Can I say goods sent is 60,000 cost, sale price 80, so profit will be 20 if all the goods are sold. Then further 50,000 worth of goods are still in inventory of X Limited. 50,000 is not cost, 50,000 is sale price. Why? They're telling worth of goods are still in inventory of X. If they are told Y, then I would have taken it as cost. Because it is from the perspective or standpoint of X, goods remaining unsold, stock left unsold is 50. If 80,000 worth of goods sell, you make 20,000 profit. On 50,000 worth of goods, how much profit will you make? 50 into 20 divided by 80. If you want, I can identify profit percentage and then apply. But this is easy. 50 into 20 by 80. What do we get? 12,500 is the unrealized profit to Y Limited on the goods sold by Y to X. By Y to X sale only unrealized profit 12,500. On another day, you would have taken this 12,500, deducted it that from that inventory of 99 and taken to balance sheet. But 99 is not book value, 99 is agreed value. Already we've deducted 10%. Already we've deducted, andre on entire 1,10,000 we've deducted 10%. Am I right? So unrealized profit worth of inventory 50 is there. No, in this already 5,000 is deducted. Already 5,000 is, we have to deduct 12,500 from what? From 1,10,000, not from 99. If you take 99, basically we are deducting 10%, no? For agreed value computation. Already 10% of 50,000 is deducted in the process of amalgamation. We are taking the inventory not at 1,10,000 into Y Limited's balance sheet. We are taking it at 99. So that 50,000 worth of inventory, it's already reduced by 10. We made it 45. So I would have to eliminate only balance 7,500. If you want to find the cost of this, do 15 to 60 by 80. What do we get? How much does it come to? 37. So cost of the inventory is 37,500 and selling price is 50. That 50 in X Limited balance sheet, when I'm taking it to mine, I'm done already in the minus 10%. It's already become 45. 45 will be reduced to 37,500, not 50 to 37,500. 50 to 37,500 is the reduction totally. Already 5 reduced in agreed value computation. How much is the reduction? 45 to 37,500. 7,500. 7,500 is the unrealized profit. So what is the inventory agreed value? What is the inventory agreed value? 99,000. So I would take inventory of X Limited 99,000. From that I would deduct my unrealized profit 7,500. You would get 91,500 to be the price to be taken to balance sheet. You understood? Already on that 50,000, 10%, that is 5,000 is deducted. Balance 7,500 is to be adjusted now to reduce totally 12,500 of unrealized profit. Everyone understood this? This is one thing which has been newly included in this question, main part of the question. Unrealized profit should be eliminated from stock and profit. Who sold? Y Limited. Y Limited's profit has to be reduced. Y Limited's profit we don't know. They should have given, no? They have not given. That is the reason this is extract. If they had given, from that I would have reduced unrealized profit of 7,000, not 12,500. Inventory now I'm reducing 7,500. Here I'll reduce only 7,500. Till now, majority of the questions that we did, it used to get adjusted with goodwill. But here it is not. You understand the reason? Number one, it is sold by big company to small. If small company, the transferor had sold to transferee, you are supposed to eliminate it from transferor's profit. But transferor's profit, why will we take? That would have again gone to their shareholders. So we'll write goodwill to stock. But here transferee company has sold goods to transferor. So we write the entry as P&L account debit to stock. P&L of big company, transferee company has to be adjusted. Everyone understood? This is 0, this is minus 7,500. Very nice. So D is not there, R is not there, U is not there, M and S. So inventory done, trade receivables 1,17,000. I am supposed to take this to my balance sheet, but I'm supposed to eliminate mutual indebtedness, which is how much? 20,000. So shall I take it to my balance sheet? Trade receivables of X Limited 1,17,000 minus mutual indebtedness 20. It will become 97. Got it? This has to be eliminated from trade payables also. I don't know trade payables right now. I'll write minus 20. If you deduct it from X Limited's trade receivables, you deduct it from Y Limited's trade payables. But we don't have Y Limited's info. Wrong question, Tarai answer that. But you can't tell the institute is wrong when they give the question. So let this be this way. What next after this? That's it. Question is over. So in our entries, we are done till here. Trade payables taken over 1,00,000 60. I'll write this 1,60,000 also in our notes to accounts. Come on here. I would write trade payables taken over 1,60,000, eliminated 20, 1,40,000 is the trade payable. Come back to assets taken over, everything done. Net assets already done. Goodwill, how much is our goodwill now? 1,08,000. Shall I write it as intangible assets straight away in the balance sheet? Yeah, there is a possibility that some of you might have written 1,08,000 goodwill minus unrealized profit 7,500. Got it? But this is ideal way of presentation. That might still make your balance sheet tally. You might just lose on 1 mark if you do that. Instead of 14, you might get 30. Then what do we have next? Goodwill done. PC. Cash. We gave 3 lakh. Hey, there is no cash balance of Y Limited given to us. How will they give? It's given out of bank. Assume it to be given out of bank. So this will become negative bank balance of Y Limited. So I'll write this as bank overdraft in the balance sheet. Don't write minus cash. Please, please, please. Inventory and cash are two things which cannot be negative. I'll write bank overdraft, other current liability 3 lakh. And then we've given shares, PC. How many shares? 2,440 shares. 2,400. In my share capital, I'll write 2,440 into 100. And in my reserves and surplus, I'll write security premium 2,440 into 25. Can I? Share capital. I don't know my authorized capital. I'll leave it blank. I'll write paid up capital 2,440 equity shares of rupees 100 each. All the shares are issued for non-cash consideration 2,44,000. And security premium, same 2,440 shares of 100 were issued at 125, meaning 25 rupees per share is premium. 61 minus 7,500, 53,500. All notes to accounts are done. I'll just post the numbers to balance sheet. 244, note number 1, share capital. Note number 2, reserves and surplus is 53,500. Note number 3, trade payables is 1,40,000. And bank overdraft, I didn't open a note. We can total liability side, but later. Come to tangible assets, PPE. PPE 441. Inventory 91,500. I'll write two things at a time. 441. Inventory 91,500. Last item, trade receivables. Note number 6, 97,000. Ta-da! Take the total. 7,37,000. Also check the total on the asset side. Tally ಆಯ್ತಾ? ಆಗಲೇಬೇಕು. ಆಗಲಿ ಅಂತ ತಾನೇ ಮಾಡಿದ್ದು. Did you all like this? New question. ICAI Study.